Hello everyone, welcome to Google Accounts. Today I will take a basic topic. I will discuss about cash book. It's a very basic topic, right? So, if we start about telling what cash book is, I will not get into details about technical terms and all. I will just try to tell you something in very easy language so that you can actually solve the questions in which you need to prepare the cash book, right? So, let us see what a cash book is. You know that every business has many transactions in which cash comes in or cash goes out. That means these transactions involve payments and collections in cash. So we have to maintain a book to record these transactions which involve cash. This book is known as cash book. Very simple. We have to just keep in mind that the transactions which involve payments or receipts are recorded in a book which we call cash book. Now, if you talk about recording of these transactions, it's very simple. We know that we have two rules of accounting. We did before traditional rules and modern rules. If we follow the traditional accounting rule, cash being the current asset, we all know that will be covered under real account. Now, what real account says? Real account says debit what comes in and credit what goes out. Right, very simple. And we have a modern accounting rule. Now, cash being an asset, we know that it's a current asset, right? So we will use the modern rule as debit the increase in asset, as modern rule says that all the increase in asset will be debit. Any increase in asset will be debit, right? And any decrease in asset will be credit. Very simple. We all know the modern rules, we all know the traditional rules. We have to just apply the rules on the transactions. Right, now how we will solve these transactions? Very simple. When we are going to prepare the cash book, we have to just read the transactions carefully. Why? Because we have to observe first of all that given transaction is a cash transaction or a credit transaction. That means either we are giving or receiving cash at the time we are performing that transaction, or we are not giving or receiving cash at the time when we are performing the transaction. However, the cash will be paid or received later. In the transactions in which cash will be received or paid later are known as credit transactions, right? And the transactions in which cash is paid or received at the time when it actually occurs are the cash transactions. Very simple, we all know that. Now, if it is a credit transaction, just ignore it, as we are going to prepare a cash book and there is no place of a credit transaction in the cash book. Very simple. Now after that, what we need to see? We need to observe that is the transaction getting cash in the business or taking out cash from the business. We can make out. We can just read the transaction. The first step we did was we just observed that it is a cash transaction or a credit transaction. If it is a credit transaction, leave it. Move to the next transaction. But if it is a cash transaction, we have to see whether cash is coming in or cash is going out. If the transaction is giving cash in the business, then as per the traditional concept, debit what comes in? Very simple. And as per the modern concept, debit the increase in asset, as a cash balance is increasing, which is an asset. Very simple. And if we talk about the other side, which says that if the transaction given to us is taking cash away from the business, then as per the traditional concept, credit what goes out, and as per the modern concept, credit the decrease in asset, as cash being an asset is decreasing. So I have told you how to use both the concepts. Now it's your choice. You want to use the modern concept or the traditional concept while doing the cash book. It's very simple. Just go through it. It will be very simple for you guys. Now in the next video, we'll try solving some simple questions. That's for now. Bye bye. Take care.